If you're a stock trader, you've probably heard about level 2 stock price quotes. Well, this week, I'm going to explain what they are and whether they matter in your decision-making process. Plus, I'll do my analysis of the market. There were some worrisome moves this week. We'll discuss what those are, and then I'll walk you through a day trade and the day trade of the week on EOSE. So level 2 quotes. You've probably heard of them if you've been around the markets for a while. Do they matter? What are they? Let's discuss. On screen right now, you will see an example of a level 2 price quote. On the left side of the screen, you can see the buyers lined up for Microsoft, and on the right side, you can see the sellers. Now, I did this when the market was closed, so it's really not as complete as it would normally be. You would have many more levels of buyers and sellers, and the spread between the bid and the ask would be much tighter. So you see right now there's people willing to buy at 258.20 and there's people willing to sell at 258.41, and the spread there is 21 cents. Well, on a stock like Microsoft, because it's very liquid, because it's very actively traded, that spread will typically be a lot tighter. So that's one of the things that is useful about level 2. But let's talk a little bit about the history of level 2 and how people used to use it to make trading decisions. Now, it doesn't take, much of a leap of faith to say, well, if I could see a stock that had a lot more buyers lined up to buy than there were sellers lined up to buy, that stock might go higher. And also, if you could watch this screen over time, you might see a certain buyer always coming in, and then you have a sense that maybe there's a large buyer in the market trying to accumulate shares. And that's really what level 2 used to be good for. Back in the old days of trading, when electronic trading first started, there was something or people that called themselves the EOSE bandits. Now, EOSE stands for Single Order Execution System, and that was the system, as it was called, which showed you these lineup of buyers and sellers before they called it level 2. Or really that's the execution system. So the level 2 is the screen that you would watch. You would see, okay, a lot of buyers, or there's an aggressive buyer that's there. And so the EOSE traders would watch that and make decisions based upon it. The problem was eventually people started to figure that out. And eventually electronic trading became more sophisticated, and people started to fool the system by putting up fake orders to buy or fake orders to sell. And then just before they would get filled, they would pull those orders. So you might say, put an order to buy 5,000 shares on the market of Microsoft. Someone would say, oh, there's a buyer of Microsoft. I better buy it before them, and they're going to have to start bidding the price up, and I'll make money from that. So that game started to get played, and eventually what happens is the level 2 screen isn't trustworthy anymore. Now then, also with the more advanced things that have gone on with electric trading, you have all these pools of liquidity, like dark pools. And so what you see in level 2 isn't necessarily what's even out there anymore. There could be a lot more buyers than what you see, or there could be a lot more sellers than what you see. So that's a long way of saying there's a lot of games that get played with level 2 orders. There's also something called iceberg orders, where if you wanted to buy 10,000 shares of a stock, you can do an iceberg order where you only show 100 shares at a time in the market. And again, you don't want to spook the market. So if you're wanting to sell 10,000 shares of a high price stock, you only show 100 shares at a time. So someone watching the level 2 screen says, well, there's only 100 shares on the sell side, not realizing that there's actually 9,900 more shares behind that. So the point then is level 2 from a decision-making process isn't really that effective anymore. I don't use it. I haven't used it in a long, long time. The only thing I use it for is to ascertain liquidity. If I look at a level 2 screen and I see the spread between the bid and the ask very tight, so the buyers at say $9.99 and the sellers at $10, that's a 1 cent spread, that tells me that there's some good liquidity. If the stock has a 20-cent spread on a $5 stock, that means there's going to be a lot of slippage. When I buy it, I have to buy at the offer, and if I wanted to sell it, I have to sell at the bid, and that spread can be wide. And I'm simplifying things, of course, but that's the basic idea. So I look at level 2 just to get a sense of liquidity, get a sense of if I buy a large order where am I going to get filled at? What is the average price I'm going to pay? All right, so that's a little less on level 2. Long and the short of it is I don't really use it anymore. I used to a long time ago, and really I take a quick look at it to see where liquidity is, but you can see the breakdown. It's useful for understanding liquidity, but you can't trust what you see. There's really not a great message in it like there once was. All right, let's get into this week's market analysis. We'll jump over to the Stockscores website, punch in the symbol of the S&P 500 ETF, SPY. We had a little bit of some rocky market action this week, and I'll explain that when we get into some other charts as I go through this. But you can see that we've been in this sort of gradual downward trend after going up nicely in January. So it's very typical. You move up, you pull back, and then you continue the upward trend. The concern is we haven't broken this pullback. It's been underway for a couple of weeks now. And there was a little bit of extra weakness on Friday, which sort of tells us that maybe the sellers are starting to get motivated. So I'm a little concerned about that, and I'll explain why in just a minute. It's still not a terrible chart. The long-term chart is still trying to turn. It's the short term that we need to be a little bit concerned about. All right, what about the small cap stocks? That's a good representation of what the retail trader is doing. And if we look at the 1 month chart there too, we see that it also has been in this little bit of a slide, but doesn't look quite so bad. I still think we could see this break higher in the near term. The stock scores are pretty good. If we look at the 3-year chart of IWM, you can see that it is trying to stabilize after the big sell-off in 2022. We're now building rising bottoms, but we've got an uphill battle because there's all of these levels of resistance that are going to slow the market down. So it's turning, it's stabilizing, things are looking better, but you still have to be pretty picky about what you trade, particularly with longer term trades. The longer term trades still aren't great. There's pretty good day trades, some swing trades out there. They come in waves. I would say last week was a pretty slow wave, but we have a long weekend, so that's not too unexpected. I think following the long weekend, as we go into March, action should pick up a little bit, let's hope. All right, how about the Canadian market? T.XIU is the symbol, and I'm going to look at the 1 month hourly chart first. You can do that very quickly on Stockscores with these quick links at the top of the chart. I'd like to always look at multiple time frames. So you punch in the symbol and then check your time frames. And you can see the Canadian market breaking down a little bit through support this week, a little bit of pessimism coming in. This will make a little more sense when we get into the commodities and what's driving that this week. But there was some weakness in gold and oil, and that may telegraph more weakness for the Canadian market in the near term. Well, let's now look at some of those commodity ETFs. There's the gold, and you can see that this steep upward trend was broken a few weeks ago, and we've been moving down ever since. It's not unreasonable for a market to go up, have a pullback, and then continue. But until we start to see some rising bottoms build here, I think you want to be fairly careful with the gold stocks. Now, what about oil? Let's take a look at one of the ETFs, BNO, and let's take a look first at the 3-year, and you can see that it's still in a downward trend, but also long-term still sort of in that upward trend. It's kind of struggling with the trend line right now. So it's kind of a neutral market. It's trying to stay some stability in here, and prices are good. So if you're an oil producer, prices are pretty good. Your cash flow is good. That industry is doing fairly well, one of the better industries out there, I guess. But there's no more upward trend to get people excited. So it's kind of quieted down a little bit. All right, so what's driving some of the weakness we saw this week? Well, I think the market is starting to worry a little bit about more interest rate raises. We saw the bond market, and I'll take a look at TBT, which is an inverse of the bond market. And you can see over the last week, 2 weeks, it's been moving higher, much like it did here. Now, we still have a situation that the tops are falling. So that means the sellers are still in control over the last 3 or 4 months. But this strength is a bit of a concern because it shows that the market, where it thought that the cycle of raising interest rates might come to an end soon, it isn't over yet, at least not in the market's mind. And that's a concern. And that's what drove the US dollar. So let's jump to the chart of the US dollar, UUP. See all these things connect. The US dollar starts to rise because the bond market goes down, the interest rates go up, makes it more attractive to put money into the bond market because interest rates are higher, and that's what drives the US dollar. Money flows into the US denominated bond market and creates more demand for the US dollar to do that. All right, so that's why that US dollar is stronger. Now, is it a big concern? Not really yet, because it's coming off of a low, not off of a rising bottom. It's still inside this downward trend. It's just sort of broken that one. So it's an area of concern. Market not so sure that the cycle of interest rate raises is over, and you can see the nervousness. The speculative market a lot quieter. Those small cap stocks which are sensitive to interest rates, certainly not as strong in the last week or two as they were in January. But keep in mind also that February historically is one of the worst months of the year for the market. You have optimism at the start of the year, and then it kind of wanes. People get in the doldrums of February. Typically, things then start to pick up March, April, May, and then you get the quieting of the market in the summer, perhaps with a summer rally like we had last year. We had a good summer rally in August, but you do tend to see volumes pull back in the summer. So that's how we think the cycle will play out, but I just want to make everyone clear that there is some concern, those interest rate raising, or the perception that interest rates are not done going up yet. So my ratings then, you can see on screen, I remain long-term bullish on US stocks, but lowered my rating to neutral in the short term. Same for Canadian stocks, neutral short term, but long-term neutral. And I'm concerned mostly about those commodities. If the US dollar continues to be strong, gold and oil get hurt, and that's weighing on the Canadian market a little bit. I've lowered my short-term rating on gold to bearish, long-term neutral, oil neutral on both time frames. Same for the US dollar, same for Bitcoin. Let's look at the chart of Bitcoin, because it is something that I think is becoming worth trading again. There's been lots of action in the Bitcoin miners, and you can see that the downward trend on Bitcoin was broken. Now we've built a rising bottom. We had actually not a bad week for Bitcoin this past week. If it can break out through this level and start to go up, then not only do the cryptocurrencies look a little better, but also the companies that mine cryptocurrencies. It seems silly, but you're generating Bitcoin by running math algorithms, sucking a lot of electrical power. And there's companies that do that, and they make money doing that. So HUT, MARA, RIOT, there's a few of them. You can Google what are the Bitcoin miners, you'll get a list. But those stocks have actually been doing okay. I don't really like them long term, but for a day trader, swing trader, there's been some action there. All right. So let's get back to the ratings, and then neutral on interest rates in both time frames. Could see a little bit of pickup there, so we'll keep an eye on that because that is a concern. And of course, I'll touch on that here every week so you get my sense of where that market is going. All right, now let's jump into the day trade of the week. And of course, we do day trading on Stockscores through our active live service every day, live webinar. You can watch that all day long. Algorithms running in real time. I have powerful computers running algorithms, looking for stocks that are behaving abnormally that we can catch before the crowd catches them. And it was a pretty slow week for day trading last week, but this particular stock, EOSE, was one on a slow Friday that did okay. And I have a strategy called a superhero. It involves stocks making my action candle break. So that's that indicator right there, the little yellow dot, making an action candle break from a predictive pattern. So this pattern here is called a pennant pattern. And if you know to watch it, it's a pretty obvious signal, but the algorithm is what finds that in real time. So entry there, didn't have to rush into this one. It didn't move anywhere for about half an hour. And then it started to move nicely, got up to 6 times risk. So these lines here are risk reward lines. And that's all part of what I teach in the Stockscores training programs that you can get more information on at stockscores.com. So the nice upward trend, and then the linear upward trend line broken there. So that would be good for about 4 times risk. So if you risk $100, you make $400. If you risk $1,000, you make $4,000 on that trade. Liquidity was pretty good, so you could take a reasonably good sized position in this stock. And on a slow day, there was always something to trade this week. Every day there was 1, 2, maybe even 3 good trades, but you had to be fussy, you had to be patient, and wait for those good trades to come along, because the market is not helping right now. It's hindering us a little bit. So you have to be extra fussy. And the key, and I talk about this all the time, the key is focusing on alpha, focusing on stocks, trading abnormal volume, because that's where the crowd is. And there's a few stocks like that every day. And of course, we focus in on those each day when I'm running my active live webinar. All right. So hope you've enjoyed that. Let me know if you have some topics that you would like me to cover. This week's topic was submitted by one of our viewers on YouTube. So I always look at those. And if you have some things you'd like me to cover in future weeks, please let me know with a comment. Give me a thumbs up if you enjoyed the video, and most importantly, subscribe to the channel and trade well.